In the world of accounting, understanding the distinction between capital and revenue is crucial for businesses and financial professionals. These two concepts may seem similar at first, but they represent fundamentally different types of financial transactions. Capital refers to the funds invested in a business or used for long-term purposes, while revenue typically refers to the income generated from normal business operations. Both play a vital role in determining a company's financial health, but they are treated differently on the financial statements. This video will explore the top 10 differences between capital and revenue in accounting to help clarify these concepts and their respective impacts on a company's finances. 1. Definition. The first and most significant difference between capital and revenue lies in their definitions. Capital is the money or assets invested in a business to generate income over the long term. It can include physical assets like property or machinery, as well as financial assets like shares or cash. Revenue, on the other hand, is the income a business earns from its regular operations, such as sales of goods or services. It is the day-to-day income that a business generates through its core activities. 2. Nature of transactions. The nature of transactions involving capital and revenue is quite different. Capital transactions involve investments or acquisitions that affect the long-term financial standing of the business. For example, purchasing property or equipment would be considered a capital transaction. Revenue transactions are typically recurring and related to the normal operations of the business. These include sales of products, services, or any other income-generating activity that occurs regularly. 3. Time frame. Another important distinction between capital and revenue lies in their time frame or duration. Capital is generally a long-term investment intended to provide benefits over a long period, usually more than a year. This could involve investments in buildings, machinery, or long-term assets that will help the company in the future. Revenue, by contrast, refers to the income that is earned within a short period, often within a year, through ongoing business operations. 4. Effect on financial statements. The impact of capital and revenue transactions on a business's financial statements is different. Capital transactions affect the balance sheet. When capital is invested or assets are acquired, they are recorded as long-term assets and increase the company's capital or equity. Revenue transactions, on the other hand, are reflected in the income statement, also known as the profit and loss statement. Revenue appears as the top line of the income statement, showing how much income a company generates over a specific period. 5. Impact on profit or loss. Capital and revenue also differ in their impact on a company's profit or loss. Capital does not directly affect profit or loss. It represents the value of the company's assets and is part of the company's equity, not part of the income-generating process. Revenue, however, directly affects profit or loss. It is a critical factor in determining whether a company is profitable. The more revenue a business generates, the higher its potential for profit. 6. Examples. Examples of capital and revenue transactions further illustrate the differences between them. Capital examples include the purchase of land, equipment, buildings, or investments in shares of other companies. These are investments meant to support the long-term growth and sustainability of the business. Revenue examples include income from product sales, service fees, rent received, or dividends from investments. These are earnings generated from the primary activities that keep the business running day to day. 7. Treatment in accounting. The accounting treatment of capital and revenue is quite distinct. Capital expenditures are recorded as assets on the balance sheet, which will be depreciated over time, in the case of tangible assets. This depreciation will affect the company's income statement as a non-cash expense over the useful life of the asset. Revenue is recognized in the income statement, and it is immediately included in the calculation of net income for the period. Revenue is generally recognized when it is earned, regardless of when the payment is received. 8. Role in business growth. The roles of capital and revenue in business growth are different as well. Capital serves as the foundation for business growth, providing the necessary funds for expansion, asset acquisition, or the development of new products and services. Revenue, meanwhile, plays a key role in sustaining and maintaining business operations. It is the primary source of funds for day-to-day activities, covering operational costs and allowing for reinvestment into the business. 9. Liquidity. The liquidity of capital and revenue can vary significantly. Capital is typically less liquid than revenue. Capital investments are tied up in long-term assets, which may not be easily converted to cash without selling the asset or incurring a loss. Revenue is often more liquid, as it represents the cash or equivalents received from sales, services, or other business operations. This cash flow can be used to cover immediate business expenses or reinvested. 10. Tax implications. Tax treatment of capital and revenue also differs in terms of deductions, exemptions, and reporting requirements. Capital expenditures may be subject to depreciation or amortization for tax purposes, reducing taxable income over several years. These expenses are not immediately deductible but are instead spread over the asset's useful life. Revenue, on the other hand, is typically taxed as part of the company's income for the fiscal year. Businesses pay taxes on their net income, which includes revenue after deducting expenses. Since revenue is considered part of the company's earnings, it is subject to income tax in the year it is earned. Understanding the differences between capital and revenue in accounting is essential for both business owners and accountants. While capital represents long-term investments in the business's future, revenue is the income earned through day-to-day operations. These two concepts are treated differently on financial statements, affect profitability in various ways, and require different approaches to taxation. By grasping these distinctions, businesses can make better financial decisions, ensure proper accounting practices, and create strategies for sustained growth and profitability.